Welcome back. We're here to talk about another topic. It's very important with a 1031 exchange called related parties. Related parties are very important in a 1031 because the IRS understands that if you're dealing a 1031 exchange, you're to be an investor. And if you're working with a related party, there's obviously reasons not to be an investor anymore. You'll do things special, specific to make it work for you for tax purposes. Again, the 1031 exchange is not to avoid paying tax. It is to defer the tax into a new property that you want to buy and held for investment use, not for personal use. So obviously, if you have a related party in the transaction, then you have an issue that it's no longer really an investment. You're doing this for personal reasons. For example, you want to buy a home with this 1031 exchange for your son or daughter or family member to live in with no rent, nothing like that, just because you want to be friendly to your family. That's not allowable in a 1031 exchange. So again, you cannot buy a property as part of a 1031 exchange from a related party. You can sell one of your investment properties to a related party. In other words, you can sell a current investment property to your son, daughter, wife, spouse, whatever might be your related party as part of the 1031. But when you buy a replacement property, it cannot be from a related party unless that related party is also qualified to do a 1031 exchange, and that related party also does a 1031 exchange and holds their asset for 2 years and you hold your asset for 2 years. Not too bad, but it kind of ruins the party a little bit for those just trying to get money to their family members. So what I recommend is this. When you're considering a related party, you want to take into careful consideration that what it is you're trying to accomplish is really for investment purposes for at least 24 months. So let's talk about when a related party makes sense. Remember, related parties could also be other entities that you own under different tax IDs. You could be the 51% owner of a corporation. That's a related party to you. It could be your LLC that's disregarded for tax purposes, but being reported on your tax return as you. That's still a related party. You're self-dealing. That doesn't mean you can't deal with that entity, but that entity must also be able to show that that property was held for investment or productive use in a trade or business and qualify for the 1031 and also do a 1031 exchange to buy another property. Again, a little confusing, but let's keep it simple. Let's say, for example, you want to buy a property for your child or son or daughter to go to school to live in during their college years. A lot of our clients do this because they know how much they can get for rent for their friends renting from their family member as well. So let's say we buy a small house near one of the major universities in the town they're living in, next to the university, with a 1031 exchange. Your son or daughter moves into it to live there. You're going to charge that son or daughter or that related party market rents, the same rent you would charge anybody that would be in that property that's not related to you. They can in turn have other people live there with them too. That makes it even better. Why not? Let them learn how to be an investor the best way possible by actually doing it, not even realizing it. Make them clean the place up. Make them do the repairs. Make them do the maintenance. Anyway, that's called a related party transaction. Very careful, very important. We understand that when you have related parties, you must be very careful to make sure that you're doing it correctly, they're not breaking the rules. Always check with your tax advisors. Contact us to talk about what you're trying to accomplish. Let's make sure that we don't bend that infraction. Related parties are very good, but they could also be very bad. So be very careful about that. What if you have a family member, an elderly parent or a mother or your father or mother that needs a place to live because they need to be taken care of? You can do that, but they must pay you market rents. Not a problem. For at least 24 months. That's to qualify the 1031 exchange. Again, it's the situation where we have to be very careful. Again, thanks for listening. That's related parties. Always contact us before you move forward with one of these transactions. Pause. We're back. I want to talk about seller financing in a 1031 exchange. Seller financing has become a very, very popular means to distribute real estate as part of a sale of a highly appreciated piece of real property. What we're finding is the reasons that clients are doing this is that they've gotten older, they've got a great tenant, They've always rented from them, but that tenant is having troubles finding property, maybe qualifying for a new home to buy. But I wouldn't mind leaving and exiting this situation, letting them to have the property. I don't want to lose the income from the property being rented. I'm simply going to do it on seller financing. I'll take, for example, I'll sell the property to my tenant for $500,000, for example, and I'll ask for a $100,000 earnest down payment on the property. I will carry the $400,000 at some rent that I feel is right, but it must be at least market rents to make it a legal note. And I will carry that note for a period of time. It's called an installment sale. My CPA says it's a great idea because I will only pay the taxes on that seller financing as I receive the principal payments. I will always pay taxes on the interest earned, no problem, no harm, no foul. But as I receive the principal payments, I will be taxed on that as well the year I earned it. And now I get to spread that tax liability over a number of years, making it less burdensome and much more palatable to deal with. My tenant, who is now my owner of the property, is going to be responsible for taking care of it. And the $100,000 down payment that I received, I either can put it in a 1031 exchange and buy a new piece of property with it and defer the tax on that, or I can simply elect to say I'm going to pay the tax on the $100,000 the year received. It's your choice. But here's the problem with seller financing. What if the buyer, your tenant, decides, hey, this property's gone up significantly in value these last couple of years, and I qualify for much better property, and I'm tired of living in this community. It's time to move on. And they decide to sell the property. Well, you then are going to receive 100% of the tax liability the year they do that. Let's say it's 4 years later. Well, that's good. Now you got a big tax bill on the $400,000. You've already paid tax on the $100,000. Now you pay tax on the $400,000 or what's left of that. Now the problem is the real estate values kept going up while your buying power went down because of the tax liability. Again, not a great thing because you got to replace the income lost with this transaction. That's where it gets to sting a little bit, knowing that the seller financing caused me that issue later in my retirement years when it's going to count most, when I really don't want to be buying more real estate if I don't have to, and I certainly don't want to worry about my income going down when it needs to be going up to match inflation. That tax liability will create that. Also to remember, a seller finance note, when I should pass, will not receive a step up in basis as if I sold the real estate itself and did a 1031 exchange. It will not step up. My estate will continue paying that tax. Again, it's a little bit of a bite, a little bit of a sting, not as bad as during my lifetime, but it's still there. Here's the solution for seller financing as part of a 1031 exchange. The 1031 exchange is a very unique vehicle. If you don't take possession of that note at the close, then it's not taxable until you do take possession of the note and receive the principal payments. So what if you put the note into the exchange and let it be part of the exchange at the close of escrow? You don't touch it. Well, later during the exchange, before you close out the 180th day, you find a great replacement property to buy. Send us the note value in cash. For example, you received $100,000 down. That went to the exchange at close. The note, the beneficiary of the note, is now the qualified intermediary at close. That needs to be changed. So it also comes to the exchange at close. It will be safeguarded by your qualified intermediary and receive the payments of that note during that 180 days. It's still your money, but you haven't touched the note. During the exchange, you find a perfect property to buy. You bring up to $400,000 of the value of that note to the exchange and basically buy the note from us. So now it comes back to you with a basis of $400,000. So now when it's paid off, it's not taxable because all of the gain went into the exchange and you bought a $500,000 replacement property with the 1031 exchange. Sounds a little confusing, but let's talk it through on a personal conversation on your specific transaction, and it becomes a little clearer. Now, here's another reason you would do this. What if the note, because again, once it comes to the exchange, it's very difficult to get money to buy the note. Maybe you don't have $400,000. Maybe you only want to put $200,000 in it. So we'll save the taxes on $200,000. Again, it's a situation specific to you. We want to have that conversation. What if we could sell that note to somebody else? Not a great idea. I've been doing this 20 plus years, and I've never been successful finding someone to buy a note from us in a 1031 without taking a significant discount, which usually equals what you would pay in tax or more to get rid of the note. And I've rarely found a seller willing to take it as a down payment, which it can happen. The note can be used as down payment as part of a 1031 exchange. So with that, the value of that note needs to come to the 1031 at close. You don't have to put the note in the exchange if you have the money at close and you know you're going to buy a replacement property. You simply can bring $400,000 closing cash to the title company or escrow officer or closing attorney at the time of close, and we receive $500,000 in cash from your sale. That would satisfy the 1031 exchange now. But most of our clients doing these seller financings don't realize it until closer to the close of escrow, and they haven't had time to actually locate a replacement property. I always say if you don't know what you're going to buy with the 1031, don't pay off the note in the beginning because now your cash is in an exchange. And if you don't find something, you're going to pay the tax. Whereas if you put the note in the exchange and decide not to complete the exchange, the note still comes back to you with the deferral mechanisms in place for an installment sale as it was intended to be. Seller financing is a very powerful tool in today's marketplace. I also use it because some of our clients, especially our larger commercial transactions, the buyer of the property gets into trouble right at the close with their lending facilities. They need an extra 2 or 3 weeks, a month, maybe 2 months to get their financing in order to complete the purchase from you. So what our commercial clients do, our larger clients do, is say, I'll carry the contract for 2 months, and I'll put it in the exchange account, and you will get your financing together, and you will give me the money to buy that off and carry the note for you later. That's another way we can transact, why we would put the note in the exchange. We have also a lot of times, for example, when cities buy properties from clients as part of a 1031 exchange. They carry the financing, telling the seller that we are going to pay you off in 8 months or in another basic, they want to push part of the purchase off into a new budget cycle for their city or town where they might be. So it's going to be required a very large down payment up front and some note that's going to be paid off in a very short period of time, typically 1 year, but I've seen them pay them off as early as 2 months. So if they anticipate the city buying the note back or paying it off early, and they know it's going to happen, put it into the exchange account, and if they do pay it off within 180 calendar days, that cash is now eligible to buy another 1031 exchange property. And I love that situation because now the city wins, you win, everybody wins, and we continue on with everything we got going on. Again, seller financing is a very powerful tool. Just understand the rules for both that and a 1031 exchange, and you'll do very well. Contact us if you have any questions about this topic. Thanks so much.